Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. The Reserve Bank of India's annual income more than doubled in the year ended June 2019, thanks to larger open market operations, a change in accounting for forex gains, and the write back from contingency fund. India's GDP growth is expected to slow down further to 5.7% in the first quarter, according to a Bloomberg poll. HDFC will sell 9.2% stake in Growth Finance through block deals. They are likely to offer up to a 3% discount to Thursday's closing price. SL Group will sell 205 megawatts of solar farms to Adani Green Energy at an enterprise value of 1,300 crores. The transaction will be complete by the 15th of October. SEBI exonerates 3 former senior executives of the National Stock Exchange in the co-location case, asks the boards to initiate action against 2. Well, let's take a look at the trade setup for the day. For our market, it's OHM, but US markets, and what did they do? Well, I think US markets in Asia have had a fairly decent run the last couple of days. In yesterday's session too, about 1.25% apiece for both the indices, the Nasdaq about 1.48%. And one, there are reasons, two, there are technical factors which are at play. The reasons, I think, aside of the trade optimism, I think when there are some optimistic news flow coming in at a point of time, wherein we're trying to highlight this yesterday as well, that wherein the difference between the yields, the bond yields or the treasury yields and the dividend yield and the S&P 500 is not too much, you would probably see people believing that there is merit in going out and buying stocks, because you will anyways earn the dividend yield and any kind of capital appreciation might just help. So I don't know whether it's the yield oddity that could bring higher reaction to some bit of positive news. Part 2 would also be technical reasons, because with this up move the last couple of days, the Dow, the S&P 500, either of the two indices, of course, are now set to move above the 100-day moving averages, and that to a lot of people is a very key parameter when it comes to short-term trading moves for the Dow. So keep that at the back of your mind. The markets did very well yesterday, and might be, if there is trade optimism, the markets could do well today as well. And frankly, that's the reason why the Asian screen as well is awash, largely awash with a tick of green. About 1% for the Nikkei, about 0.5% apiece for the Shanghai and the Hang Seng, slightly more than 0.5% for the Hang Seng. Again, optimism around trade. The point is the SGX Nifty is not quite taking off from there, because I think we have our own issues. I was making this point yesterday on Countdown as well, that we are almost back to the levels from where we started off post the announcements, or rather Friday's close last Friday, and then the major announcements which came in, which made people think that bulls are back in the driving seat. We back down to those levels. So there are issues that our markets are facing. Selling pressure at higher levels certainly happening, and FIs continue to withdraw money. And frankly, you got to ask yourself the question whether the bulls are running out of steam, because the RBI, while the report does show the income and therefore there will be no question marks around the quantum of money transferred to the government, the report in as many words does say that the slowdown may be cyclical in nature, but there are deep reforms needed to bring about the change in the economic sentiment. So that is part one. The GDP data today is very unlikely to stoke any kind of major optimism, and you will, at the end of this weekend, before Ganesh Chaturthi sets in, which is Monday is a holiday, you will have data from the auto sales numbers, maybe the cement dispatch numbers as they come in, unlikely to really bring about any kind of cheer to the market. So there is only as much macro or positive news flow that the bulls will have in the session today. You got to keep that at the back of your mind. FI outflows largely continue, so no changes out there as well. Maybe, just maybe, it will be stock specific, and today there will certainly be stock specific, because there are a bunch of stocks which are slated to react today. I've chosen 4 or 5 which I believe are the ones that are the most important. Well, Reuters report suggests that the EU regulators will approve the 2.6 billion Novelis-Aleris deal. And remember, we've spoken in the past about how not just Novelis but Aleris' performance as well was pretty strong, the data that had come out a few days back, and therefore let's wait and watch if this brings about some cheer to Hindalco. Any which ways, any kind of trade optimism will bring about a cheer in the metal name. So Hindalco could well be a stock in focus today. It may sell Aleris Belgian Pound and all of that as a separate issue altogether, but Hindalco might be a stock that could react today. Group Finance, HDFC will pay its stakes, will sell about 9.2% stake, about 6.74 crore shares via block deals today. I think as per the term sheet, they may offer up to 3% discount to yesterday's close. Let's see if Growth Finance has that downtick in the session today. We'll watch out for that. It'll be very interesting to see what the SL Group stocks do in the session today, because the group has signed a definitive agreement to sell about 10 renewable power-based companies to Adani Green. The economic value of the company stands at about 1,300 crores. Not a very large deal, but hey, it is showing action on the part of the group. And therefore, you might well see Zee Entertainment and Dish TV as well react. All the SL Group stocks typically tend to move in tandem. Maybe both of these could react in the session today. Let's wait and watch what happens. Macquarie says that the funds will be utilized to reduce the promoter debt, and all of this should be viewed positively for the company, for the group at large. PNC Infratech, it's a large EPC project of 1,062 crores, large from PNC's order book size as well, and it's been declared the L1 bidder. Let's see if this one reacts positively today. Last but not the least, SBI Life. It's very important to highlight what's happening to these life insurance firms, simply because they are charting a different trajectory right now, much better than even the banking names. As UBS has raised the target to 980 from 860. They believe the premium growth is ahead of the private peers, and that should be a key reason, amongst others, why the stock deserves a higher multiple and maybe some better earnings as well. So let's wait and watch if SBI Life were to react in the session today. However, let's tell you what's lined up on First Word today. Vishwanath Nair first Johnson to take us through RBI's annual report to show how the central bank managed to transfer that 1.76 lakh crore to the government. Pallavi then tells us what could have hurt India's GDP growth rate in the first quarter. Yatin Johnson to tell us how one of those indicators is showing no signs of recovery. Somit then joins in next to throw some light on whether it makes sense to focus on high dividend yielding stocks. And Sharad wraps up today's packed First Word with a comparison between two listed exchanges in India, BSE as well as MCX. The RBI's decision to transfer 1.76 lakh crores to the government has raised eyebrows, or had raised eyebrows over the past few days. The FY19 annual report throws some light on how that may have been possible. Vishwanath Nair reports.
Now, in the last few days, there has been a lot of debate about this 1.76 lakh crore worth of surplus that the Reserve Bank of India is transferring to the government. And there has been a lot of questions. There have been a lot of questions about how exactly the RBI arrived at that such a large amount. Now that the Reserve Bank of India has released its annual report for the financial year ended June 30, 2019, we have a fair understanding on where that money came from. And just the first look at the RBI's annual report would tell you that its annual income for the financial year 2019 came up to 1.93 lakh crore, and that is more than double of what it made in FY18. So obviously that is a large increase in its annual income that has helped the RBI transfer a large amount of surplus to the government. How exactly this 1.93 lakh crore number comes, for that we have to look at each individual items, and just to get a sense of it, most of this increase has come because the other income for the Reserve Bank of India has gone up. So let's look at some of the components of the total income that have contributed in this increase. So firstly is the additional interest income of about 33,000 odd crore. That has come primarily because the RBI conducted a lot of open market operations during this financial year in FY19, and because of that it accumulated a lot of government securities, and thereby there has been an increase in the interest income that it has earned. Second, and probably the more important component of the entire annual income, is the revaluation gain on the foreign exchange that the RBI holds, and that has come up to about 29,000 crore. So just to get a sense of how exactly this happened, the Reserve Bank of India moved to the weighted average cost model of valuing its foreign exchange reserves. Earlier it was looking at it on a weekly basis, and now this weighted average cost model, according to the Reserve Bank of India, India had a net impact of about 21,000 odd crores. So that is why the total gains from the foreign exchange reserves came up to about 29,000 crore. The next important item is also the contingency write back. Now, as part of its assessment of the RBI's economic capital framework, the Bimal Jalan committee had suggested that the RBI is holding excess provisions, and therefore probably some of those provisions can be written back. So that 52,618 crore has been that contingency write back that the Reserve Bank of India has done in FY19, which obviously added to the surplus. The other additional sources have added about 11,000 odd crore, but obviously some of the top three are the more important components of the overall income, which has helped the RBI not only increase its income but also then transfer more money to the government. Now that there has been some kind of revaluation as well as some reassessment of the RBI's reserves, let's look at where exactly these reserves stand. So the contingency fund, remember that we told you there was some write back in the provisions, so that has come down from 2.3 lakh crore to about 1.96 lakh crore as a direct result of that write back of provisions. The next and probably the more important sort of reserve to look at is the currency and gold revaluation account. So that, if you remember what I told you earlier about the weighted average cost model, because of that, the overall balance in the CGRA has come down from 6.9 lakh crore to 6.64 lakh crore. So obviously, all of this is adding into that additional income that the Reserve Bank of India has made during this financial year, and thereby to the actual surplus that it is transferring to the government.
Well, that should give some answers. We'll wait for some answers about India's growth as well, because the growth rate is expected to moderate further in the first quarter. A Bloomberg poll of 30 economists have pegged GDP growth at 5.7%. That's a drop from the last reading of 5.8%. Pallavi Nahata tells us what will weigh in on the numbers.
A majority of high-frequency indicators and quarter-end corporate commentary indicate that economic growth may have weakened further in the April to June 2019 quarter. GDP growth is expected to fall to 5.7% from 8% an year ago, according to a Bloomberg poll of 38 economists. The growth rate in the fourth quarter of the last financial year stood at 5.8%. If growth remains below 6% in Q1, it will be the first time since 2013 that India has seen 2 consecutive quarters of sub-6% growth. Gross value added is estimated to grow by 5.5% in Q1 from 5.7% in Q4 of FY19. This was according to 27 economists polled by Bloomberg. GVA strips out the impact of indirect taxes and subsidies, providing a better indicator of underlying economic trends. Emerging trends indicate that consumption that's driven economic growth in recent years is weakening. Consumption growth in Q4 FY19 stood at 7.2% compared to 8.4% in the preceding 3-month period. Since then, output of discretionary consumption items such as cars has declined further. Quarterly earnings data from consumer staples companies has also shown weaker volume growth. Should consumption growth slacken, hopes of private investments picking up will also dim further. A recent survey from the RBI showed that seasonally adjusted capacity utilization fell 1.1 percentage points to 74.5% in Q4 FY19. Weak demand can lead to capacity utilization falling further. Moving on to industry trends, economists expect some improvement in manufacturing growth compared to last quarter when growth fell to 3.1%. The index of industrial production grew at a slightly faster pace in the April-June period compared to the 3 months prior. This could imply slightly stronger growth for manufacturing. Electricity growth could support overall industrial growth further, while weakness in construction may pull it down. While services may see slower growth, agriculture is likely to pick up.
Agri picks up, the other factors are just so weighing in that you would not see a good number. I mean, whether it's 5.7, 5.6, 5.8, 5.9, I doubt that really that will bring about some rekindling of the animal spirits. The numbers and the economy is not looking like, at least showing signs of any kind of pickup, and therefore the numbers for the numbers that will get released today, I really doubt they'll be anything dramatically better than what is anticipated. Let's wait and watch. The next piece on First Word. This year has not been too kind to equity investors overall, with a host of issues plaguing the markets, be it global turmoil or domestic worries back home in India, the GDP numbers that we spoke about as well. So would one stand to make more by turning to stocks that pay a handsome dividend? And if so, which are those stocks? Sumit Sarkar is here with the list of companies which give a handsome dividend. We'll try and then weigh in on whether it makes sense to invest into them or not in the first place. Sumit, good morning.
Good morning, Neeraj. I'll start off with the top 10 companies that have the highest dividend yield for the financial year 2019. So Nalco tops the list with a dividend yield of 15.1%. Then we have Vedanta, which has a dividend yield of close to 15%. SJVN, that is Satluj Jal Vidyut Nigam, 9% dividend yield. NLC India, 8.4%. REC, 7.9%. Now, in the top 10 list, if you see, nearly 9 companies are government companies, and the only private company on the list is Vedanta, that is a dividend yield of 14.6%. So what is dividend yield actually here? Dividend yield is a ratio between the dividend that the company has given in an annual year divided by the share price. Now, dividend yield for a company could be also higher because of the fall in the share prices. So we are not saying that investing in these companies would have given a good returns, but it would have given at least some assured returns to the shareholders in form of dividends. That is what we are trying to prove. And then on the next 5 list, we have Indian Oil Corporation, National Fertilizer, Coal India, Oil India and HPCL having a dividend yield of close to 7 to 8%. All government companies. In the top 10, 9 companies are government companies and only 1 private company, that is Vedanta. So I'll start off with Nalco, which tops the list with a dividend yield of nearly 15%. As you can see here, this is a dividend trend that the company has been doing. Now, the company announced a dividend yield of close to 5.75 rupees per share in financial year 2019, which was the highest in the last 11 years. Now, this was after a buyback of close to 505 crore rupees that the company did in November 2018. Now, second on the list is Vedanta, which is the only private company which has the highest dividend yield of 14.6%. And in FY19, as you can see here, the dividend yield of the company is nearly 19 rupee. Dividend of the company is clearly 19 rupees. Now, this is not the highest dividend per share that the company has given in the last few years. As you can see, in FY18, the dividend was 21.2 rupees, and in FY17, it was close to 19.5 rupees. But the dividend yield of the company is still higher, and that is because of the fall in share prices that we had seen in Vedanta in financial year 2019 and post that. Third on the list is SJVN. The company also has a healthy track record of giving dividends of close to 3 to 2 rupees per share. Now, this is and if you see, the company has also done a buyback of around 800 crore rupees last year, and post that it has given a dividend of close to 1.7 rupees per share. So this would have given some returns, some assured returns to shareholders in financial year 2019. Along with that, we also have NLC India. Now, this company has also been consistently rewarding shareholders, but the quantum of dividend payout has come down a bit of around 4.5 rupees from 7.4 rupees what the company had done in financial year 2017. Now, if you see compared to previous years, that is FY14, 15 and 16, the dividend payout is higher at close to 4.5 to 7.4 rupees, but that could also be because the government was trying to meet its disinvestment target, and because of which the dividend per share might have increased for this company. Then we have RECL, which has also a dividend yield of close to 7.9%, and in FY19, the company had given a dividend of close to 11 rupees per share, which was the highest in at least the last 5 years. As you can see, from FY14 to FY18, the dividend on an average has been close to 7 rupees, and in FY16 to FY18, it has ranged in the range of around 8.5 to 10 rupees, but in FY19, the company did a dividend of around 11 rupees per share. Then we have Indian Oil Corporation, HPCL, Oil India. For Indian Oil Corporation, if you remember, FY19 was the highest ever payout where the company has given to its shareholders. It also did a buyback of close to 3,300 crore rupees. So it's mostly the government companies that have been giving a high dividend yield. But if you see the share price performance of these companies, that have been not good for so far in the last 1 year. So these companies have not given great returns to shareholders, but at least some assured returns in the last financial year, that is FY19, in form of dividends and other payouts like buyback, etc.
Yeah, thanks for that, Sumit. 2 plates from Sumit's presentation, and we should highlight them. First, the fact, as Sumit started off saying, that this dividend yield for FY19 need not be necessarily a replica of what will happen in FY20 as well. The dividends may have been higher for very completely different reasons, including what the government has done in order to, that is to ask PSUs to give in the higher dividend for a particular year because it served multiple purposes. Part 2 is that very interesting chart which showed the quantum of dividend that Nalco has paid over the last 8 or 9 or 10 odd years, and that will give you a story, wasn't it? What's happened in the previous year need not necessarily happen in the year to come as well. Nalco has been downgraded by a number of companies. Earnings are under question mark. And Sumit, frankly, even if Nalco has given out dividends of 5.5 in the last couple of years, the collapse in the stock price, people would have thought that Nalco was a great dividend yield play, even at 10% dividend yield. Now, if it became 15%, that was because of the fact that the fall in the share price. So the capital loss put paid to any kind of gains that the person may have gotten because of the dividends.
Yes, exactly. That's what I was just trying to say. This investing in these shares does not mean that you will get great returns, but at least some assured returns in form of dividends that the company has been paying so far in the past.
No, absolutely. This is a great fact check. So viewers now know which are the companies that typically have given high dividend yields and are trading based on FY19 dividends at such yields. If you believe that fundamentally the company can give such a dividend, please go out and buy, but please do your own due diligence. This is just an analysis of what the dividend is looking like. Sumit, thanks so much. Fantastic piece of work out there. Well, that's some stocks which have a higher dividend yield. Move on. Markets have seen heightened volatility for the past couple of months, but two companies that provide platforms for all this trading activity are showcasing divergent trends. While MCX shares are trading at the highest levels in 20 months, BSE has fallen to almost 52-week lows. Sharad Dubey is standing by to tell us what's likely to have caused this divergence between the performance of the two listed stocks. Sharad, good morning.
Good morning, Neeraj. I think first we need to look at the one-year chart basically to see the divergence, coming in regarding the performance of the exchanges. Now, if you see, the MCX has been hitting its 52-week highs regularly, but BSE has actually hit its 52-week lows as recently as August 16. Up next, we see the market capitalization in which MCX has outperformed BSE. Now, if you see, there has been a point of divergence for the month of September 17 onwards. The market capitalization has, started going on a divergent basis, with almost MCX having the market cap of almost 4,800 odd crore rupees and BSE's market cap falling to around 2,600 odd crore rupees. Up next, we see there was a strong recovery in the volumes we have seen in the bullion sector, and because of that we see the MCX gold rates which have been hitting its lifetime highs, and it's trading at around 38,000 per 10 gram mark. Now, if you see, these are the factors which have actually put MCX in focus. Apart from this, we see the turnover pictures for both exchanges. Now, we have taken a 5-year compounded growth rate to see which segments have performed. Now, if you see for BSE, the equity cash segment has performed and it has been negative at 4%, while the currency derivatives has gained by almost 25 odd %. In terms of MCX, the bullion has actually increased 6% compounded growth rate, and this average daily turnover has actually come up to its pre-demonetization levels. That is something which we'll be watching out for. And even for the energy, with a lot of volatility happening in the commodity sector, almost it has grown by 51%. Apart from this, even a couple of regulatory conditions have helped MCX. The first one being the approval for the institutional participation, the second being the launch of indices, and the third being the tie-up with retail bank subsidiaries. Apart from this, we need to see why BSE is in a tough spot. Firstly, this is because of the falling revenue in the transaction charges we see. Apart from this, there has also been a slow shift of commodity volumes from MCX. Now, mind you, I need to add one more point, is now the commodities are tradable in your NSE as well as BSE. Apart from this, the equity market share has actually fallen, by almost 2.5% to 7.4% on a year-on-year basis. And recently, 14 BSE traded stocks were, listed in the NSE, and stocks like SpiceJet and Westlife Development coming in, which was not auguring well for BSE. Apart from this, the listing revenues have also fallen due to the compulsory delisting, and there has also been a delay in revenue from the new platforms like INX Exchange and the insurance. Apart from this, let's see what the analysts have to say. For MCX, the return potential stands at around 4.4%. And for BSE, it stands at around 21.2%, with the buy rating for MCX standing at 78% and for BSE 100%. And the 12-month target price, according to Bloomberg, for MCX is around 986, and for BSE it's 651. So, Neeraj, suddenly there's a lot of interest in the exchange space when it comes to trading, and a couple of factors I would like to point out, going ahead. One more reason being, NSE, the listing news of NSE coming into play in the next couple of 12 months. This will surely add up a lot of interest in the exchanges sector.
Yeah, well, it could, but we've been waiting this for a long time now. Let's wait and watch if indeed it happens, and it happens in a hurry. Thanks so much for that, Sharad. But divergent performance between the two bourses, which is Bombay Stock Exchange and MCX, both owned selectively by some smart money managers. BSE not doing much. MCX certainly reaping dividends. The last piece on First Word today is about autos, naturally so. It's about time that we do that. Now, August is expected to be no different for automakers, with all the players set to report lower sales numbers for the month. And a high base is only going to make it worse for the larger players like Maruti as well as Tata Motors. Yatin Mota is here to take us through what the Bloomberg Quint brokerage poll has thrown up. No positive surprises expected, I guess, Yatin.
Yes, and Neeraj, you hit the head on the nail. Clearly, we have the overall auto sales which will look muted. This is largely to do with the fact that last year, same period, we had the festive season which started 10 days earlier versus this time, which is probably 10 days late. So if you look at last year's base, that is large. Probably because of that large base also, there will be a base effect and hence a steep decline in auto sales. Let's talk about the passenger vehicle segment first with companies like Maruti expected to see a 32% drop on a year-on-year basis as far as the wholesale numbers are concerned. And do remember, the management also has said that they are looking to rationalize inventories from the current levels. Tata Motors also, the commercial vehicle sales and passenger vehicle sales together, the domestic market is expected to see a 43% decline. Ashok Leyland and Mahindra are also expected to see a steep double-digit decline in the overall volumes. Of course, for Mahindra and Mahindra, the fall would look slightly lower given the fact that the base is low, and more importantly, there are new launches which are aiding the overall volumes at this point in time, of course, with some fillip from that segment. Tractors, now this is one interesting space wherein we are expecting the flattish sales trend for both Mahindra and Mahindra as well as Escorts. So both of these companies are expected to report some flattish kind of a number on a year-on-year basis. Of course, there is seasonality also because of which we are not looking at much change which could happen here. As far as auto sales in August is concerned, Hero MotoCorp is expected to see a steep 24.5% decline because the base is larger and clearly the rural market is not picking up there. Royal Enfield, the story continues here. TVS and Royal Enfield both are expected to see a decline of 15% odd. Bajaj Auto will clearly outperform the two-wheeler segment with a sales decline of only 10%. It's to be seen that how their export markets also shape up at this point in time. But clearly, it is higher inventory as well as muted demand, which could impact most of the auto sales numbers this time. And of course, for the Eicher Motors Royal Enfield business, we'll watch out for how Bullet 350, the new launch, has done for them in terms of the overall volume contribution.
Which is the one that you're watching out for the most, Yatin?
So Neeraj, Eicher Motors is something that we'll watch out for. Their Bullet 350 with an 8% discount to the current model has been launched in the marketplace. The reception is good according to our dealer checks. So probably that one number could surprise on the upside if the volumes for Bullet 350 pick up, because that is almost 22% of the total sales. So if that changes significantly, then we could see some small uptick in their overall numbers to the expectations.
Well, let's wait and watch. And that's the synopsis for the auto sales numbers. They'll come out over the weekend. So important for you to get these numbers at the back of your hat. Yatin, thanks so much for putting that into perspective. Well, I don't know if I hit my head on the nail or not, but the auto companies certainly have done that in the last few months. The numbers haven't been improving. Let's wait and watch if that changes. That's all that we have on First Word today. Lots more lined up on Indian Open, though. We'll discuss markets and what to do in a scenario like this with a sell-side person. Narendra Kumar of Elara Capital joins in to talk about what is it that they are advising their clients to do. Government's infrastructure push and NHAI not being asked to stop doing more work. Vinayak Chatterjee, chairman of Feedback Infra, weighs in on that, and how Berger Paints managed to beat the consumption slowdown with the managing director Abhijit Roy. But after this break, a full tilt towards the day's trade.